Okay, good morning, everybody, and welcome to our Introduction to Global FX Payments and Risk Management webinar by BeztForex. The objective of this session is to provide a high-level overview and the principles of cross-border transactions and trade. Please post your questions in the Q&A section, and we will try to answer as many questions at the end. And I'll also try to answer some of the basic questions in the Q&A section as well. So let me briefly introduce our company to you. BeztForex is a foreign exchange intermediary assisting corporate and individual clients through our partner banks with their foreign exchange transactions. Rudi, our MD, will give a more in-depth presentation on our company later in the webinar. As you can see, our agenda, so we will be covering the topics of setting the scene, the SA link, financial surveillance, or in the old days, exchange control, foreign exchange, global trade practices, and then we will finish off with the BeztForex value proposition. I'm going to introduce our speakers to you. Our speakers for this webinar are Herman Bezuidenhout, our CEO and founder, and he will be covering the topics of setting the scene and global trade practices. Rudi Bezuidenhout, our MD, will be covering the topics of foreign exchange and BeztForex value proposition. And Gerhard Wilson, head of sales, will be covering the topic of financial surveillance or exchange control. So we shall go to our first speaker, Herman Bezuidenhout, our CEO.
Good morning, ladies and gentlemen. Thank you, Warren. My name is Herman, as Warren said. So my background is I've been doing international trade and foreign exchange for the past 46 years. And I'm just going to share a few high-level slides with you regarding the global trade landscape and also the South African landscape. Now, unfortunately, there's a lot of slides. So for today's session, it's going to be just introductory. So we will, in future, handle more of these things as we proceed. So let's start by just taking a look at the global trade and forex landscape. And it's amazing to see that every single day, $7.5 trillion are being traded. That accounts for all the trade and investments globally. And that number increases all the time. The interesting fact is that the dollar remains the dominant currency. 88% of all trade still takes place in the dollar. The second most important currency is the euros. And the interesting thing that stands out that small South Africa accounts for 1.1% of all global trade. And you can see our trade is on par with some of the other major emerging markets in the world. Again, we're just going to focus on the high-level stuff, and we can elaborate on these things later. So coming back to South Africa, the global trade imports of goods and services in South Africa accounts for 60% of our total GDP. Very few people realize this, just to show how important this is to the country. And once we add all your foreign direct investments for companies and private individuals and all the people immigrating and foreign nationals working here and we working there, this number goes up to 80% of South Africa's GDP as some form of global trade, foreign investment leg. Very busy slide. I'm just sharing with you the world and South Africa, some of the changing trade and industrial policy landscapes. So if we briefly look at the 1960s, the world went through a process of high import tariffs, extensive use of non-tariff barriers, all in an attempt to be self-sufficient and protect your own internal manufacturing processes. In the late 1980s, South Africa started to be a lot more outward-looking. It started increasing government support for exports. Most of you are too young. There was a scheme called GISE, General Export Incentive Scheme. But as the world moved on, following the 94 elections and then up to 1999, we became part of the World Trade Organization, and specifically the Marrakesh Agreement, where there was a phase down of import tariffs and the removal of export subsidiaries and non-tariff barriers, all in an attempt to open the world and to allow people where there's competitiveness to source and sell products. And then from 2001 onwards, we became very much part of this whole global world and the globalization and international competitiveness. There was an increased use of all the WTO-friendly supply-side measures. Interestingly enough, from 2009 onwards, quite a few of the large countries in the world became a lot more inward-looking, and it looks like we've gone backwards a little bit from self-sufficiency in the 1960s. That trend is now going back, and this was mainly caused by the global financial crisis and the Trump era, COVID-19, and all the current wars that are going on are forcing some of the big countries to start looking inwards and towards self-sufficiency. My personal view is that globalization is here to stay. It will be a major driver in the future for economic growth and from a country's perspective. Very quickly, and again, there's quite a few slides. I'm just going to touch on some of them because we don't have time. You can see how South Africa's international trade has grown exponentially since 1995, with a resultant effect on our balance of payment, which is the current account of the country. Unfortunately, I can't explain all these bumps in here. We'll do that at a future date. The thing is just to realize trade has an effect on your current account, and it can be positive or negative. This is another quick slide, just showing month to month for a few years. And what I want to point out is look how these events have an effect on our exports and imports. So COVID, strangely enough, had a massive positive effect on our exports, as you can see from these lines, and it also contained imports. So over the past few years, South Africa is in a very positive position from a balance of payment perspective due to the positive effect of imports and exports, and it continues to in that fashion. Our most important import trading country, region is Asia, mostly China. You can see on the top of that, and you can see from 2009 how it has grown. Europe is still a very important destination for us to import from, and you can see the rest of the world also down the line. Looking at exports, again, Asia coming right down from virtually nothing to where they are today. And the one that's the new kid on the block is Africa, which is very good for us because when we export to Africa, it's value-added goods, which has a lot more margin for South Africa. You can see how Europe has dropped a little bit. Here, still very important for South Africa and the rest of the world a little bit down the line. I want to share this slide quickly because on the one hand, you can see in Asia, we have an imbalance of trade. We source a lot of goods from Asia and we don't export that much. It's still a lot, but in the overall position. So you can see from a balance of payment point of view, we're negative. The rest of the world is pretty balanced. And our export growth into Africa is helping us tremendously with balancing our trade balances. So if you look at Africa, Africa now accounts for 29% of our exports, 548 billion rand. But it's only 90.4% of our exports goes to the SADC countries, a few countries around us. And look at this enormous potential to start exporting to these other countries in Africa. High level, unfortunately, we cannot spend too much time on this. All this stuff is in the public domain, and we will in the future share some of these things with you. You can see all our import top 20 destinations, and the favorites are there, and then exports on this side. And that's where you'll see the African countries coming to the fore in terms of exports and the growth that we've seen happening there. Again, this is in the public domain. We should know what are we importing and what are we exporting. So there's the top 20 of import categories, and you can see mineral fuels, vehicles, and machinery. So South Africa imports a lot of value-added stuff, and when we export, it's more raw materials and the big winner for South Africa is vehicles that we are exporting. But yeah, this could be a very good source of information for you to strategically see where you should export to. Thank you very much, Warren.
Thanks, Herman. We're going to move on to Gerhard, who's going to be talking about financial surveillance.
Thank you, Warren. As mentioned, my name is Gerhard Wilson. I am the head of sales here at BeztForex. I will be doing a brief introduction into financial surveillance for you guys, just a couple of slides before we set off the rest of the webinar. A few things we will be going over is just the background of financial surveillance. We're also going to be looking at what it generally aims to achieve, and then how all of this also ties into South Africa's grey listing as well. So why exchange control? So exchange control was introduced into South Africa in 1939 to restrict the outflow of funds, manage and administer the movement of foreign exchange within South Africa. So it does that through permitted limits, as well as the balance of payments for SA's current accounts. So some basic principles. We look at our documentary evidence, our BOP categories and reporting, authorized and permitted transactions, and as well as SARB applications. These are some of the principles that are implemented in order to execute our exchange control, methods to document payments, to list them with the categories that they fall within, which helps with the reporting as well. Then we also have payments that need to be authorized and permitted as well, which is done to the South African Reserve Bank. And that brings us to the actual exchange control department. They are there to execute, administer, and enforce the rules that we are trying to implement here. They are mandated through the Reserve Bank. All approvals are internal, and they are the ones who are responsible for the balance of payments reporting as well. Just a few points here of money flowing inwards and outwards. What are the categories where they flow in and out of? The top is obviously going to be cross-border trade as our number one. Number two, we look at foreign direct investments. This is obviously going to be foreign entities that invest funds within the South African market. Number three, we look at offshore capital. That is where a South African will send funds to foreign investment vehicles, as well as money exiting the country. Then there's obviously immigration, which we all know is a very big part of it. Then our SA residents who are also temporarily abroad, and our foreign nationals who are within South Africa as well. And then lastly, our payments to non-residents in terms of agreements, which will obviously be money flowing out of the country as well. Just a quick look at how this ties in with grey listing. And as we all know, South Africa is on the grey list, unfortunately. We have made massive progress. There is still 5 of the 22 technical deficiencies which need improvement. The agencies that ensure that steps are being taken for us to get to the point where we are no longer on this grey list is obviously going to be the SARB, the South African Reserve Bank, as well as the FSCA and the FIC, the Financial Sector Conduct Authority, as well as the Financial Intelligence Center. There is an oversight and scrutiny on fronts when we look at FICA, especially on anti-money laundering, which is the main aspect. There has also been a massive focus on looking at suspicious transactions, apologies there, to point them out and to ensure that those become less common, which will obviously aid to us not being on that grey list anymore. And the whole thing falls under South Africa's financial surveillance, which is the steps that we can take to improve our international trade and to make sure that we stay compliant as well. Thank you, Warren.
Thanks. Thanks, Gerhard. Okay, we're going to move on to Introduction to Foreign Exchange by our MD, Rudi Bezuidenhout. Rudi,
Thank you, Warren. Yes, thank you for everyone joining. We're going to talk about, or I'll cover the topic of foreign exchange today, introduction and calculating the different types of currency, exchange rates, and how we carry on forward with risk policies. So the first one of foreign exchange and the principles around it is that where does foreign exchange come from and how does it get determined? The exchange rates get determined by the market. It's obviously a supply and demand that gets offered, and where the currency exchange rate lies between your home currency and your foreign currency required. The interest rates on forward exchange contracts gets calculated by your home country's interest rates, and then also when your counterparty exchange rates and country and that country's interest rates get calculated across each other to give you a forward contract rate. Next slide, please. So for the man on the street and companies that do importing and exporting, where do they find the exchange rates currently available? And as technology has grown over the years, we can hear it over the news, radios, media. We can Google it. We can go on apps that's available to us. And banks normally use larger versions of these rate feeds, like Reuters, Bloomberg, where they get their currencies from on a more accurate basis to receive internally and to give you, the client, a rate to exchange on. How do these value dates get determined, and what are the value dates? So the value dates, if your counterpart in another country needs the funds today, or there's an urgent payment to be made, there is a value date for today. There is a value date for tomorrow, and the nominal one that gets used is the spot rate, that is 48 hours. I'll elaborate a bit more on that. The fourth value date we get is also a foreign exchange contract, and that is to secure a rate of today for a future use. And in this instance, that's where the interest rate between the two countries plays a role to give you that forward exchange contract rate as well. As you can see in the bottom right-hand corner, when importers do utilize forward exchange contracts, the interest rate plays a role to make the exchange rate more expensive. And when exporters utilize forward exchange contracts, yes, they then receive more currency for their rand when they do exchange their currency. More to elaborate on this in a couple of slides to come. Here we can now explain the proper evaluations of the rates. As I said, value today, it's the immediate rate, and it's the less expensive exchange rate that your bank would offer to you, just by illustration purposes. Value tomorrow is the second lowest rate costing that one would get, and the spot rate is the nominal value of 2 days in advance to set out global payments to your foreign suppliers. Forward exchange contracts is utilized on a risk basis to secure a rate of today for a future date when you need to pay your suppliers, or when you are receiving currency from your clients. How do these rates get determined? And as any business, they have a product, they add value to the product, and they sell it to their clients. In this instance, the product for the bank is the currency, and the interbank rate is the cost that they get the currency at. They calculate that interbank rate. They would add a little bit of margin into that interbank rate to cover their own overheads and their own internal costs, and then they would give the client a rate that would essentially be your cost that you would exchange currency at. How do these exchange rates, how do you read the exchange rates when you see it on all of these platforms? And there's always a rate on your left side and a rate on your right side. And to determine currency coming into the country, it would always be on your left side. The bank would be buying the currency from you, and they would give you your rands. And on the right-hand side, the bank would sell currency to you, taking your rands as a counterpart on that. So the nominal rate that gets used is the spot rate. This rate is 48 hours due on value date after you've booked your deal. The spot rate is usually 2 days. It's a 48-hour value from the day that you've done the deal. This 48 hours allows for all the admin to take place from the client to the bank to make sure all the documentary evidence is correlated and correct. The counter amount, your rand amount, or the count amount is in accounts to pay away to your supplier or to receive, and it allows, like I said, for all the admin to take place and to make sure that payments are the due diligence on payments are done. When it comes to forward exchange contracts, as I said, companies use forward exchange contracts to hedge today's currency or rate for a future date in terms of risk and risk appetite to that particular invoice or that particular payment term of your supplier. And it allows you to also cost your client in the interim as well, to fix your cost instead of having a volatility as the exchange rate changes on your cost rate. A quick illustration to show how the costing works and the different type of exchange contracts that one gets. So there are 3 different types: fixed, partially, and fully optional. And for the illustration, you can see on the right-hand side where the cost increases from 1815, 1816, and 1817 as an increased cost on what type of contract you take. You can see the fixed contract, the top one, is for a fixed date. That's when you want to deliver the currency to your supplier on a fixed date. The partially optional one shows that there are 2 different dates that one can choose from. And essentially, because you close out your exchange rate for that period of time, the exchange rate gets a little bit higher. And fully optional is from today until a future date where you can then also withdraw or draw down currency as you go along. That one usually is for companies that would budget ahead, 3, 6, or 12 months, and they would then stipulate the typical currency, and for that period of time, they would draw down at exactly the same rate to pay over to their suppliers. Let's talk about currency accounts, CFC accounts, and FCA accounts. Yes, any company, any individual are allowed to have currency accounts in South Africa. For companies, it's called CFC account, and on the right-hand side for individuals, it's called FCA accounts. There are multiple uses for these types of accounts. When it comes to exporters would receive currency in these accounts. They would then park their proceeds in that account until they see fit that the exchange rate is in their favor to either then convert to rands and take the profits into the company. They can also use these currencies that they've parked in the currency account to pay out for imports again, and they can also exchange cross currency to another currency to pay out as well. Importers would use currency accounts when they see that the currency is in their favor, the rate is in their favor. They would outright buy with cash flow currency. They would park it in the CFC account, and there's a ruling that says in 31 days, then the currency has to leave the account and go to your supplier. On the third block, on swaps, when FECs, the forward exchange contracts, plays out and the value date arrives, one can then outright buy that currency out of the exchange contract, place it in your CFC account, and transfer it out to your counterpart within 31 days. A little look at currency volatility and what it's played for South Africa in the last day, the last year. And also from a company in South Africa with these volatilities, it has to be one of the biggest challenges facing importers, exporters, and individuals when in the realm of exchanging currency. We will talk about how to mitigate your currency risk and the values of it, and to do it or not to do it. Here we can see the 1 day of volatility in South Africa just on the dollar, and from 1809 to 1826, and eventually coming down to 1817. That's a great jump in 1 day, and there are various factors that allows for this volatility, and 90%, unfortunately, this volatility is what happens outside of South Africa. So all the positive and news that we receive inside South Africa and the build of the country has very little effect on what we do in the emerging market space. And if we can see the second slide, in the last year, huge ups and downs, and it's worrying for a company that's importing or exporting to price on product, to cost their client, to make payment terms with their supplier. So we will talk a little bit how we can get all these ups and downs a little bit smoother. Creating the risk and what it entails. Importer and exporter as a natural consequence of having cross-border operations, and then that risk volatility comes with it. There's loads of exposures happening around the world. There's loads of information one can gather from media, from news, and then also fake news and so forth. And where one should take care of volatility in currency is when repaying or paying invoices. We see a lot of companies waiting till the last minute to pay an invoice. We see companies that panic and pay too early. And also when multinational companies that we serve, there's huge inflows of currency, of loans, of capital entering the country, and there are agreements when and how to pay the currency back to head office or financial departments, and there's interest rates applicable to these loans as well, that one has to be care of and taking currency risk volatility. This is a quick measure on how a small company, a medium, a large corporate, listed companies can take the emotion out of when and how to book currency and do deals to pay away or receive. And it's to determine the risk factor inside a company. Is it low, medium, or high? What framework will we do forward exchange contracts, or when will we purchase currency, when will we not? And then identifying that measure and living up to that measure. One's board should sit together and say what this measurement should be, and stick to that measure, stick to that policy. And every quarter or every half year, when a board sits together, have a look at your historical. Have you done well of booking in time, booking when the framework said to book, and then as this document is live, adjust to one's exposure and risk appetite. Thank you, Warren.
Thank you, Rudi.
Good luck to the following practice in the webinar.
Okay, so we're going to move on to global trade practices, which will be presented by Herman.
Thank you, Warren. Yeah, so this is quite a tall order. So normally, when I run a global trade practice and risk course, it takes me a week, 8 hours times 5, so it takes 40 hours. So in 3 or 4 or 5 minutes, I'm just going to share a few things. Again, as we said, this was really just a high-level introduction to some of these principles. Let me just get sorry. I always start with this picture where, and this is what I was taught very at a young age in the bank when we started trading internationally, is you draw a picture, a line that reflects the sea, and then cross-border is normally to another country. Always an importer and exporter in either country. And the most important thing is there's always a bank involved. So banks play such a crucial role in this whole process. And you can see between the importer and the exporter, there's always a sales contract, a pro forma invoice, and then goods move and payments happen. And obviously, there are always risks involved in this in terms of payment and non-payment, and how do we mitigate that? And the big thing is to maintain a relationship with your local banker and always be prudent and compliant. On the left-hand side, there's a whole range of financial instruments that are being used in the world of trade. And when I talk trade, it's both the financial supply chain as well as the physical supply chain. So I'm not going to go through all of these, but there are a number of these financial instruments that are involved, and BeztForex also are able to facilitate most of these. So the most important thing would be the cross-border payment and the foreign exchange conversion that goes with it, and of course the FX risk management. But as you move on with the payments, you need to find ways to mitigate the payment receipt or making payments to suppliers. So trade, as you've seen from my first slides, where it shows what impact trade has on countries, individual countries, and globally. Here's just a few things in terms of why is trade so important for a country. And if you just look at the Far Eastern giants like Korea, Thailand, China, and all of those, their growth has been spearheaded by trade. So it's really to boost development and reduce poverty, but there's a whole range of benefits that country will get from increasing their trade, including improving the quality and the labor environmental standards, because it's part of your competitiveness. And then the last one is it really creates employment, because the more you manufacture, the more product you create to export, it all leads to employment and growth in the economy. So at the high level, at the highest level, there are 3 major pockets of risk. So it's commercial risk. So the commercial risk, and remember, if you're in South Africa, if I sell to a company in Durban, it's much easier to analyze the creditworthiness of a company locally. When you do cross-border, it becomes a different ball game. And the second one is where, as an exporter, you now have to face, in addition to commercial risk, the country risk. The country in question, do they have foreign exchange? Do they have the ability to pay? I mean, the client in the country may have a local currency, but there's no foreign currency in the country. And the last one is the foreign exchange in transactional risk. And as you've seen with Rudi, foreign exchange is one of the major risks that we have. But in addition to that, there's a transactional risks where clients sometimes don't adhere to the sales contract and all those other things. So just to be aware that there's a totally different set of risks applicable when it comes to global trade. So the most important document when you trade internationally is the sales contract. And it must always be in writing. And it doesn't need to be a full-blown sales contract. Most companies deal with the pro forma invoice takes the place of a sales contract, as long as all the terms and conditions are encapsulated in either the sales contract or the pro forma invoice. You know, shipping terms, method of payments, and you know, all the pertinent conditions relating to the trade. But a very important document. And as Gerhard mentioned, on the financial surveillance, an authorized dealer bank will always call for documentary evidence when you know, when allowing clients to make payments. Just another thing I want to highlight is in the world of international trade, there must be a method to define the responsibilities and obligations of the buyer and seller. When does risk move from one to the other? And for that reason, the International Chamber of Commerce, many years ago in the early 1900s, have initiated the Incoterms, and the latest version is 2020. It's short for International Commercial Terms, and it's a set of standardized rules. And you can see there are currently 11 Incoterms, and the most obvious one is FOB. And as I said, that determines, you know, who takes the risk regarding the payment, and as from a logistical perspective. So this is my last slide, and this also takes about 2 days to unpack in detail. So I'm just going to talk about the payment methods. So open account, currently in South Africa and the world, 90% of trade between countries and clients happens on open account. Open account simply means the exporter knows the importer. There's a relationship. So the exporter will ship the goods to the importer in terms of the sales contract and the pro forma invoice, and will rely on the importer then to pay. And that, so open account comes with time and with building a relationship between the two counterparties. And you order, I ship, you pay. And that's also the most secure to the buyer, because if a buyer, an importer, has that type of relationship with the exporter, he will place his order, receive the goods, he can inspect it, and then pay. Then the most secure payment method for the exporter is calling for an advance payment. So this is in a case where it's a high-risk country, there's no foreign exchange, and the exporter will insist on receiving the proceeds in South Africa before goods are being shipped. These other two products are very important. These are financial products that are there to help clients when they don't want to do open account, or where the exporter don't want to make an advance payment. And the one is called a letter of credit, and it has various permutations and risk factors, including standby letters of credit, demand guarantees, and all of those things. And then the collection one is a watered down version where the bank plays post office and control the flows and the release of documents to the client. But yeah, this is just a high level overview, but these are the four major payment methods. Open account, between 90 and 95% of world trade. And the rest makes up the balance. So all importers and exporters should strive for an open account relationship, and that can only achieve by building a relationship and trust with your current partner. Thank you.
Thank you, Herman. Okay, we're going to get Rudi to just do a presentation on our value proposition. Thanks, Rudi.
Thank you, Warren. Yes. So apart from the educational information that we've given out to the audience. Our company BeztForex, what we do and how we work. And we are intermediary in South Africa that lies between the bank and the client, where we assist clients with all onboarding, back office functionalities, exchange control, financial surveillance services, and also helping client understand the landscape of foreign exchange. So a couple of the main benefits from using our services. We are one of the largest intermediaries in South Africa, and that comes together with competitive exchange rates that we get from the bank, and that competitive exchange rates we offer then to our clients. And that makes, out of everything that we've seen today, the clients a bit more competitive when it comes to exchange rates and the volatility around it. You can see that we've got a single bank transaction fee. All of our staff has 10, 20 plus years experience in the banking industry that could help with the all-round service when doing your payments and collecting all these documentary evidence for the bank to handle. We also do all the tax clearance certificates for individuals and the South African Reserve Bank applications for companies at no charge to the client. We assist with that whole service of retaining the certificates and the applications approvals in order to service you as a client and get your flows and payments going. How we work is we don't sign any contracts with clients. We don't ask for any commitments, and we rely on these servicing offerings to you, but you will never receive an invoice for our services. How to become a client? We've got a whole onboarding team that would assist you with a personalized service when collecting all your FICA requirements, filling in all the bank forms, onboarding you with the particular bank, and then getting all your treasury accounts, rand or currency accounts open in the easiest possible and quickest way. Thank you, Warren.
Thank you, Rudi. Okay, so we've just had one question, so I'm going to pose that question, then maybe I can just open a bit of a conversation before we close off this session. So somebody asked, how do USA interest rates affect the rand? And I think maybe, I don't know if you, Rudi, or you want to have a go at that question.
I'm going to ask Eddie Roll, one of our colleagues, to maybe comment on that.
Okay, thanks.
Hi, everybody. Our US interest rates do not really affect South Africa. It does affect the calculation of forward pricing, of course, but the way it would affect South Africa is if dollar rates are moving higher, then the dollar becomes a preferred investment vehicle, and then money will flow into the dollar. Subsequently, the dollar would get stronger, and the rand and other emerging market currencies will get weaker, and vice versa. But other than that, what happens in dollar rates does not affect South Africa, you know, in any other way. Our interest rates are determined by the Reserve Bank, not by the Fed in the US, and all other countries' interest rates are also determined by their central banks and not by the US. But they tend to follow because the global economy is either in an expansionary phase or a sideways phase. So they would follow. If interest rates in the US, like we've seen during COVID, was going up because inflation was overheating, that happened throughout the world. And therefore, every other country, or most other countries, in fact, had to also start, you know, continue with the raising of rates in order to curb inflation. But other than that, no, it doesn't affect the South Africa or the rand that much.
Thanks, Eddie. I think maybe I can just also get one of our speakers just to answer that, Herman or Rudi. So maybe we can just have a quick discussion on how the grey listing has affected the ability for us or the banks to make payments and how those payments get affected, if that has been affected at all. And I don't know which one of you would like to answer that.
Yeah, I can take a little bit of what we've seen in our operational ability with clients, and also the operational ability with the banks taking action on clients and the grey listing from here on in. As we've seen, only 5 of the 22 points has been improved over the when last we've been on the grey listing list, and the banks take action on companies for their FICA requirements to get updated FICA and FATCA requirements in quarterly stages. Obviously, some of these clients are risk and high risk that gets more frequently FICA requirements from. A lot of our clients are also multinationals where shareholders and directors not only sit in South Africa but also abroad. And the banks have also taken action on the due diligence of the payments. Where has the shipping and shipment take place? Is there third-party payments, third-party countries in place of these payments being made and shipments being received? And so the banks have really clamped down on that requirements of the grey listing.
Okay, thanks, Rudi. Okay, we do have another question. Does BeztForex or the banking partners that we have, do they do FECs for Nigerian Naira and Ghanaian Cedi? I don't know which, Herman or Rudi.
I'll do the first part of the answer. So FECs normally are only offered in sophisticated markets. So South Africa, with its high levels of sophistication, have been offering forwards for many years. But some of the smaller and the other African countries do not do that yet. So my understanding is that we are not currently able to offer or FECs for these two currencies. But Eddie, maybe you can also just jump in there to confirm what I'm saying.
Yeah, I think number one, in the case of Ghana, they still have currency auctions, which means the central bank at the, let's call it at the end of the month, the central bank says, okay, I've got X amount of foreign currency available. Banks, give me your invoices that you want to pay, which would be client invoices. And then the central bank allocates foreign exchange according to the demand, but obviously within the limits of the foreign exchange available to them. So if there's no foreign exchange freely available in the country, there cannot be a forward market in that currency because there is no guarantee that you are going to be able to get foreign currency sometime in the future. If it's working on a currency auction basis. So for that reason, yeah, there's nothing in the Ghanaian Cedi. And in the beginning, in the early days of the South African market development, the Reserve Bank actually provided the support, but we did not have the issue with currency auctions and a shortage of foreign currency, which makes a big difference. But that's really what it's about, the fact that there's no currency available, foreign currency available in the country.
Thanks, Eddie. Danica, you wanted to say something, then I'll ask the next question that's come up.
Yes, I just also want to just respond to Garth. So depending on, so we do have partners elsewhere in the world that would be able to not directly provide forward cover, but other solutions regarding exposures in Nigeria and Ghana. So I will pick that up. We'll pick that up with you outside of the meeting, just to see exactly what your exposures are. Because as you guys know, it's a very valid question. As you know, I don't know if you've seen recently how much money MTN have lost in Nigeria because of the inability to firstly get money out of that country, and secondly to convert it to a hard currency to get the money out. So, but yeah, it's all to do with how do you create some hedge against those currencies. So we'll pick that up with you outside of the meeting.
Great, thanks. Okay, so next question from Brilliant is, what is the relationship of global events, Ukraine war, US elections, COVID-19, Israeli war, against currency risk? And I think I just want to add on to that, and maybe either Herman, you can talk about this, is the Russia issue and payments to or from Russia specifically, I think, would also be an add-on question, because I know that a lot of clients may have questions about that. Thanks.
So I think firstly, with regard to these events and the effect they have on currency risk, as Eddie has alluded to, so currencies are driven by the market and by the internal country's policies in terms of the Reserve Bank. Then it's all subject to market conditions. So we've seen that the Ukraine war specifically, of course, if you watch the currency movement between the euro and the pound and some of those other currencies, so it does have an effect. I think mostly linked to supply and demand, because when these wars happen, there's a change in goods that are being imported or exported from those countries. So it really does have an impact. But again, because the dollar dominates this whole currency market, the effect is somehow lessened. With regard to Russia, and so in South Africa specifically, and other countries, we adhere to, like our government policy about seeing Russia as a friend. In our case, the banks and most of, also driven by grey listing, will not allow transactions with Russia. And the big thing with Russia is most of their commercial banks have been disallowed to use the SWIFT payment system. So you've seen in the market how other Russians are trying to find alternative ways to receive and make payments. And also the whole BRICS initiative to try and get another currency as an alternative to the US dollar, which we've seen has very little effect, as the dollar still remains major important factor in the global capital markets. Yeah.
I think I also want to just maybe add on to that, because I actually have experience with Russia in terms of I've got a client that provides goods to Russian companies, and when the Russia-Ukraine war happened, they really struggled to get the funds from their clients in Russia, and even tried alternative methods via other countries like China. And even though China may say they are friends with Russia, it doesn't mean that their banks are necessarily friends with Russian banks, and they really did struggle to get the funds out of Russia. So it's just interesting how it has affected the flow of funds out of Russia. Okay, I had another question about just quickly about FECs, and even I think it's more about you taking out a FEC, import FEC, and what happens if the rand strengthens and now you have no need for that FEC. I think maybe if we can get an answer on that, please.
I can answer that, Warren. Forward exchange contracts is still an exposure for the client as well. The client would obviously bank on a certain exchange rate for the future and be locked into that exchange rate. And yes, what happens now if the exchange rate in the lead up to your value date strengthens or weakens? And the complexibility around it is if you had to sell that currency back to the bank, they would sell it at the current market rates. And that would mean a positive or a negative cash flow for the client. When the cash flow is negative, they have to pay the bank the cash flow. And when there's a positive cash flow, the bank will then pay the client. But yes, that is a risk as well. So one has to make sure you don't overextend your commitment when booking a forward exchange contract. And what it actually allows is for per order or your budget or per invoice or per client relationship and payment details to book currency. So please don't attempt just to go on your own without specifically knowing the ins and outs of forward exchange contracts. We've got loads of knowledge within our team that we would sit with you and explain until it's a viable product for you to use.
Okay, thanks. So before we finish off, Leonard, we're just going to give you a chance to ask your question, and then what we'll also do is we'll answer questions via email and directly with the participants. Thanks, Leonard.
Thank you for the opportunity. Through the talk, it builds more confidence for us clients to use BeztForex as our liaison with the bank. But I did not hear a limitation that we are to depend only on Capitec or SASFIN. Can you help with ABSA, FNB, Nedbank, Standard Bank?
Okay. Yeah. Leonard, so we're a registered treasury outsourcing company, and currently our relationships are only with Capitec. As you've seen in the market, SASFIN have exited the business. I see they're also busy delisting from the JSE. And then we also have a relationship with Bidvest Bank, which I see is also in the market, but Bidvest Group is also placed the bank up for sale. So currently, we are exclusively using Capitec due to their superior systems and the pricing that they offer us. We are in the process of investigating to go with another major bank to see if we can get an alternative. But no, unfortunately, all the other major banks, ABSA, Nedbank, Standard Bank, and so on, they don't allow treasury outsourcing companies to be intermediaries. So unfortunately, we can only use Capitec now, and hopefully soon we will have another bank in our fold.
Okay, thank you.
Okay, thank you, everybody. So I'm just going to close off quickly. So just to confirm that we will also be sending out a follow-up email to everybody that has attended this webinar. So with our contact details, so should you wish to engage with us further or you'd be interested in our services, you'll have contact details there as well. And then, thank you very much for joining us. And as far as possible, if there's any other questions, we'll also try and engage with you directly regarding those questions. So thank you very much, everybody, and enjoy the rest of your day.